August 21st, 2024. Today was an expanding triangle open, which, this is a really clear and, picture perfect example of what an expanding triangle open would look like. But in general, expanding triangles are outside bars on higher time frames, meaning that we're in breakout mode. So on some sort of time frame, let's use a 30-minute. See if it illustrates my point. Not really what I was trying to illustrate. Never mind. But we have an expanding triangle on the open. And I thought once we started to reverse down, there's a pretty good chance we were going to get below yesterday's low. And obviously that did not end up happening. Bar one, a bear bar closing relatively near its low. It's good for the bears. We might go a little bit lower. The bears want a double top bear flag with bar 60 and some sort of a measured move down. The bulls are hoping that the gap up is the start of a new bull trend and that bar one is just a pullback and we're going to rally back up to the bar six close from yesterday. We did end up getting back to that area over here, and that's where the bulls who bought bar six yesterday and maybe held all the way through this, maybe added more here or added more somewhere along the way, using the rally on bar seven to get out of their long. So that's where we ended, why we reversed down so sharply from that area, and why all those bulls sold, causing the initial selling here. Bar two, a bull bar, it triggers above bar one. So we trigger the high one for the bulls above bar one, but it's not a very good high one because it's a bear bar. Bulls are betting on a breakout above the higher high double top, and they want to swing up. However, bar two would have been better for the bulls had it remained an inside bar. The risk would be less, and it would make bar one not your signal bar. So if bar two is an inside bar two would be your signal bar, and that would be much preferable. Bar three, you can see the tail on bar three. So we initially sold off during three, and any traders who sold below or sold the close of one, scaled in higher, are probably going to use the tail on three to buy back their shorts. It's also just a tight trading range on the open with bars one and two. So when bar three is trading down, you're just buying low in a tight trading range, which is a pretty credible thing to do. However, bar three, consecutive bull bars, the bulls hope it's always in long. It might be always in long, but it's not all that clear. I think it's okay to be long, or sorry, it's okay to consider the market always in long, but you have to realize it's probably trading range always in long, if anything, which means that we were probably not going that much higher, even if we do go a little bit higher. Also, bar three, big tail on the top and on the bottom, and it overlaps with bar two a lot on bar three. Bar four, a bear bar closing near its low. You could argue, low one, pull back low two, something like that. You could argue it's, this is the sell off and it's a big low one and then pull back and a big low two in here. But that's really not, it's really not a very credible short, maybe 20 to 25% chance, probably more like 20% chance that it's the high of the day. So the bears, you can see we overlapped with yesterday's bar seven low. So the breakout point, that's where bar four went to, and that's where we started to see some selling. Probably buyers not too far below bar four, scaling in lower. Possible high of the day, but not a very strong one. And you can see you got buyers below four during bar five. Okay, to get out of the shorts just directly above four if you were short, but not really a lot of reason to be short. We might be forming some sort of wedge on the open. If the gap up is the first push and then the pullback is bar one, this would be the second push, two, three, and then pullback four. And then potentially getting the third push, five, six, whatever, and then potentially a reversal down. So this move up is, it looks like a leg in a trading range to me. It doesn't look like we're starting a bull trend is the point. Bar six, bull bar, good for the bulls. It's closing not quite near its high, but decently above its midpoint. And more importantly, or just as important, it closes above the bar four high. So the bar four high is a breakout point. We now have a close above that. However, the problem with six is it really does look like a third leg up in what is probably going to end up being a trading range. So looks like three legs up. I'm not really that sure I want to be buying up here. This looks like it might be more of the sell zone. You can see some traders bought the close, saw some sort of triangle here, like this. And some traders bought the close, causing the initial rally on bar seven. Bar seven rallied back to, like I mentioned, yesterday's bar six close, where there were bulls who had bought and they had scaled in. Where are those bull stops? I don't know. They're somewhere way far down, though, probably way down here, I would say, since you had a spike, a pullback, then start of the channel was down here. So, any bull buying up here on this breakout of the channel probably has to have a stop all the way down here. So, or, if you're going to scale in, at least is what I mean. I'm not saying if you bought there yesterday, your stop should be down here. I'm saying the algorithms will probably have really, really wide stops, maybe the bottom of the channel, or maybe below this low, betting that we're probably going to test back into here. So even if we do sell off, probably more buyers at a 50% correction. Maybe they buy the highest close, they buy more on the 50% correction, and they use the rally today to get out. That would be a profitable trade. So 7, a bull bar, which is disappointing, had 7-minute bear bar closing near its low. So even if it was exactly the bar that it was, but it closed on its low instead of a one tick bull body, then it would have been a much more credible short. However, it's a bull bar, so I don't really want to sell. I thought the context was relatively overdone, and all the bulls exiting around yesterday's bar 6 close would increase the chances that the remainder of the bulls would sell out of their longs of the market, panicking out. Excuse me. And giving up for a few legs sideways to down. However, I don't think it's all that great to be selling below a bull bar. So I thought the context was relatively good for bar 7, but just not really a good enough signal bar to take the short. So probably buyers not too far below. But in general, if you're a bull, you don't want to be buying below the third reversal down. It's not usually a very good idea. So bar 8, a bear bar, but a big tail on the top and a tail on the bottom. Not as good as it could be for anyone. The bulls are hoping this is just a pullback, and they have their spike up on the open of the day with the open of the day. So the gap up is their spike, and now this is their channel. So they're hoping for a spike in channel, and the bears are hoping that this is a wedge, and we're going to get a couple of legs sideways down. 9, a big outside down bar. Good for the bears, so it's a surprise bar, right? However, there's a tail on the bottom of 9, indicating that the bulls who buy below 9 are probably, who bought below bar 1, faded the breakout below, are probably going to end up making money. Additionally, if you're going to have a big bear trend, it doesn't usually start. The really good trends don't usually start with bars like 7. They usually start with better signal bars. So I don't think that it's really all that great to be selling the close of 9. I think this is going to be an area where traders are more eager to buy the closes rather than sell them. And then you get a big reversal up on bar 10, a bull bar, but a tail on the top and a tail on the bottom. Can you buy above 10? Yeah, you can buy above 10. The tail on the top is a little bit discouraging. I thought if it closed 1 or 2 ticks higher, if it closes on its high, I think it's a better trade, but it's still reasonable to buy above 10 and take a chance we've seen the low of the day, or at least the low of the next couple of hours. You can see the bulls who did buy were eventually able to make 2 to 1 of their true risk, which is right around here where we ended up reversing. So 10 is an expanding triangle, pretty obvious at this point. We have this, we have this. We're probably going to get some sort of expanding triangle open. The problem with buying 10 is it's a big bar with big risk, but the daily range is still relatively small. So I think it's okay to buy and take a chance that we end up going higher. 11, disappointing follow through. It's not all that surprising to get disappointing follow through after the bar 10 is so big, because a lot of traders are not as eager to buy this close this high in the range. You can see we traded back to the bar 9 close just about 1 tick away, and any bear who sold the close of 9 was so disappointed in how this went that they used the sell off on bar 13 to buy back their short. It's also right around a 50% pullback of the bar, so it's also right around a 50% pullback. So this whole area was clearly a support area. So it's not surprising we had bull step in. 12, an outside bar. So we have 2 consecutive doji bars, 11 and 12. Sorry. I think that, I don't know if that showed on the screen. My connector to my monitor. I have a laptop and a monitor, and the connection's being a little on the fritz. So, anyways, bar 12, so consecutive doji bars. The bulls who bought above 10 probably not too thrilled with how 11, 12 is going. However, when you buy a swing trade like this, sometimes you have to sit in the market and just let it be sideways for a little bit. When you're buying above bar 10, the market has flipped to always in long on bar 10. It might have been always in short on bar 9, but bar 10 makes the market always in long. So as long as the market's always in long, we're probably not going to fall below the bar 10 low. So as long as we continue to. And additionally, we haven't even reached the 50% pullback yet, right? So we didn't even reach a 50% pullback until bar 13. And that's where a lot of the traders are going to step in when you have big bar, big risk. So as disappointing as it is to get 11, 12 and have them be this sideways, it's reasonable to look to buy a pullback here. And bulls know that, so they're not all that disappointed. As it's still disappointing follow through, but they're not worried about it. The bulls who bought know what they did. They know it's probably going to go sideways first. Bar 13, a high one for the bulls. So good for the bulls that they're getting a high one buy in a potential bull trend, and bulls bought the reversal up from the moving average. However, it's basically another doji bar. So we have a 3-bar tight trading range, 11, 12, 13. And then we get a huge bull surprise on 14, breaking far above the bar 12 high, far above the bar 7 high. However, bar 13, we just had a 3-bar tight trading range, 11, 12, 13. So I'm not sure how much higher we're really going to go before we end up getting some sort of sideways move. You can see the traders who bought, a lot of them took profits around 2 to 1 of their true risk. So 14, a huge bull surprise. It's good for the bulls. We're probably going higher, but it's a bit climactic and there's a tail on the top. So it's probably not quite as good as it could be. It's still reasonable to be long at this point. However, a lot of traders, they get 10, 15 points here if they're just going to scalp out. 15 consecutive bull bars. Good for the bulls. We're probably going at least a little bit higher, or at least it's a trading range. Obviously, 16 is a surprise, but we're probably going at least a little bit higher after 14 and 15. However, there's tail 14, tail 15, so I'm not buying up here. This is more of a profit taking area. It's true that this should get a second leg up, and sometimes we fall all the way below the low of the day and then get the second leg up, which we did. We didn't quite get back because the bulls who bought the close of 15 were so disappointed with how this went that they just took this chance to sell to their longs over here and decided to take the small loss. However, tail 14, tail 15, not as good as it could be. And we're at the top of a possible expanding triangle. And, keeping in mind, if you were buying up here, your profit target is probably the all-time high. So you're buying, hoping we just get a vacuum test, basically up like 80 points, one of those really huge bull days. And I don't really know if I think we're going to get that at this point. So 16, a big bear surprise, a bear bar closing basically on its low, basically perfectly for the bears. It's a really strong short. It's probably the best trade of the day. The thing is, if you bought above 10, so on any average day, and 50 or 42 is a pretty average day right now, you're going to get a swing trade of about, they say, Al says in general, you'll get a swing trade every day. That's about 40% of an average day's range. But I think it's still reasonable to look for a 20-point swing. So if you bought above 10, you were not able to make 20 points, which is interesting because 90% of days should have a 20-point swing. And then you get a huge bear bar closing near its low 16. This maybe has more potential to be a 20-point swing. And you can see the bears who sold below 20, who sold below 16, were able to make 20 points exactly on bar 17. So if you sold below 16, you needed the market to go to 56, 19.5 in order for you to make 20 points. And look at the low of it. It's exactly where it went. So the traders who sell below 16 were looking for a 20-point scalp or a 20-point swing trade, and they got it almost immediately. So most of the traders just ended up taking their profit, and that was part of what's causing 18. But anyways, expanding triangle, so reasonable to sell below 16, betting we get a downside breakout of the 18-bar range and probably continue lower. I think 17 is not really a very good sell the close bar. Your risk is humongous. A lot of traders, instead of selling the close of 17, will look to just sell a 50% pullback of the whole move instead, which is where we rallied to on bar 21. So 16, 17 consecutive bear bars, strong enough to make me think we're getting a second leg down. I was a bit surprised we didn't get more of a second leg down. And on the close of 17, I thought, at least 60% chance that I would say 60% chance that we're going to go outside down on the close of bar 17. Yesterday's low is right here, and we're relatively close. We're within basically 10 points at this point. So I think it's pretty reasonable to assume that we're going to go outside down at this point, especially considering the prior bar was humongous, 21 points. So we only have to go half this bar's range down in order to get outside down. So I thought that was likely today. Obviously, did not happen. 18, a pullback. Not surprising that we're getting a pullback here because the Bears were able to make their 20 points on bar 17, or if they had more time, they could have waited until bar 17 closed, and then when 18 did immediately collapse, they got another chance to exit with 20 points. And if you still didn't exit on 18, and then you got another chance to exit with 20 points on 19, and that's what the traders ended up taking. But 18 is a low one short for the bears. However, it's on the expanding triangle bottom. This is clearly a support point the market is paying attention to. So you can see we ended up paying attention to it all the way down. So it's hard to want to sell down here with big bar, big risk on support. So low one short for the bears. The bulls, they hope this whole thing is a bear trap, but I don't think the context is all that great for the bulls over the past couple of days. As we get more and more overbought in the short term, I become more resistant to buying and a little bit more open to selling. So if there's a borderline setup for the bulls, I'm not going to take it. But if there's a borderline setup for the bears, I might take it, is the thing to keep in mind. So you have to, if you think the market's primed for some sort of move up, let's say we're oversold and you think the market is probably a little overdone to the downside, it needs to bounce soon, then you can be a little bit more generous with the setups you take that are bullish and a little more strict with the setups you would take that are bearish, and the opposite applies as well. So 19 buyers below 18, the bad low one short. A lot of the bears who sold to close, whatever, 16, 17, disappointed at 18 and are using 19 to buy back their shorts. Obviously, probably buyers below the low one short. Not really all that strong for the bears. So 19, a bull bar closing near its high. There's a huge tail on the bottom. So a lot of overlap with 18. Do you buy above 19? I would not. This is a minor reversal. You can see how strong 16 and 17 are. This is the dominating force in the market right now. This is not a dominating force. Yeah, it's 3 pushes down, but this is probably the best you're going to get. So it's really not worth taking the buy. You can see trade, they got it to rally to around the 50% pullback, but that's really it. So I don't really think that that's worth a trade worth taking. Bar 20, a bull bar, but a tail on the top. Again, it's relatively expected. We're not going to, get it. This is not going to be a huge rally. The 15 low would be probably the target for the bulls, but it's extremely optimistic to think we're going to go from here straight up to here after how strong 16 and 17 were. 21, another bull bar. So we have 4 straight bull closes, 18, 19, 20, and 21. And we have tails on, basically all 4 bars really. So 21 looks a bit climactic to me. It's rallying up into the 50% pullback zone of bar 16 and 17. And it's after 4 straight bull bars. So usually by the close comes to an end after 4 to 5 bull, or at least 5 to 6 bull bars, sometimes 4. But I don't think that's as important here. But you're around 50% pullback, or the 50% pullback of this, and you have to have a stop down here. And we're in the middle of the range. So really not all that great for me, because you have big bar, big risk, and not good probability. So most traders are probably better off waiting rather than buying the close of 21. If anything, the traders are selling around the 50% pullback during 21 and 22. Bar 22, an inside bar. You could argue it's a low 2 short for the bears or a low 1 short. Either is fine. You could say the low 2 because we traded below 18, reversed up. And you could just argue it's a low 1 because 4 straight bull bars and reasonable to just call it that. And again, around the 50% pullback, you'd be selling a low 1 short around the 50% pullback. But the problem is you're selling on a flat moving average and you're selling a doji bar. However, the risk is relatively small, which is good for the bears. 23 consecutive bear bars. You can see we traded below 22 during 23. So we did trigger the short. Any bull who bought the close of 22 and was disappointed in how 23 looked, bought the close of 21 and was disappointed in how 22 looked, they might be using 23 and sell it to some of their longs at least. 24, the second leg up, I think from 18 through 21 is probably 24. It's really not all that great because this was really not all that great of an area to buy. So we're probably going to get another leg sideways to down. The question at this point is becoming, are we going to get, rally up to 21, essentially a trend line break, a pullback, and then some sort of higher low major trend reversal, some sort of lower low like we ended up getting? Or are we going to end up getting some sort of basically, this is what it needed to look like if we were going to sell off and get a strong second leg from 16 and 17. So it was credible to be looking to sell in this area because of a strong second leg from 16 and 17. We may have briefly gone always in long on bar 21, but I don't think any of these 3 bars were enough to make the market always in long. And if this did make the market always in long, we went back to always in short here pretty quickly. So 25, possibly a second leg down, 22, 23, and then pull back 24, 25, second leg down. Probably sellers not too far above. It is a high 2. You can see sellers above 25 during 26, big tail on the top. Um, you know, probably buyers not too far below, probably sellers not too far above. To me, this is just a tight trading range. I'm not really willing to do anything. We're on a flat moving average on a trading range day in a tight trading range. So for me here, I would just rather be flat. If I had to pick between long and short, I would say I would be short. So I would say it might be always in short because I'm not all that convinced we went back to always in long. And the dominant feature of the market is still bar 16 and 17, although it seems like we're doing a lot more sideways top trading here. 27, buyers below, like I said, and then outside down 28, big bear bar closing near its low. Do you sell below 28? You definitely can. You can sell for a swing and take a chance that we get a big second leg down from bar 16 and 17, maybe below yesterday's low. You can see, I believe the leg one, leg two, I think I did it out earlier. I don't remember exactly where it was. Yeah, the leg one, leg two was down here, and yesterday's low was here, and 2-to-1 of your risk selling below 28 is here. So it's reasonable to sell below 28 and just take a chance we basically get below yesterday's low. 28, a big bear bar closing near its low. It's breaking out below the tighter range from bars 22 to 27. And again, I think bears will sell, looking for a second leg from 16 and 17. Bulls, they're hoping that this ends up forming some sort of higher low, and then we get a higher low major trend reversal. However, 28 is pretty disappointing, I think, if you're a bull. So I would probably rather not do that. 29, follow through for the Bears, but not as good as it could be. If I'm a bear, and I wanted a big second leg, I wanted more follow through than that. I wanted a really big bear bar closing near its low, like 16 or 17. Instead, I got 29. The Bulls are hoping that this is going to be the start. We're going to trade above 29 and get a big bull bar closing near its high, which is showing that bears are giving up, but probably not really much to buy down here. However, we are in the buy zone. And then when you get 30, you have tails 29 and 30, and you have to, kind of start to think about the fact that this might just be a trading range, because if the bears are going to get such, or if it's so bearish, why aren't we getting such great follow through? It's still okay to be short and take a chance when you see 29, 30, but you want an ideal bear bar relatively soon, and 31 is not necessarily ideal. It's a pretty climactic bar, and there's a tail on the bottom. So if I was a bear, I wanted 31 closing on its low and clearly breaking out below the trend line of 1, 10, and 18. Instead, it's basically closing right on it. So for me, a lot of the bears, they'll sell below and they're just trying to make 10 points. And you can see they were able to make 10 points during bar 31. And that's what ends up happening and basically causes some of the buying here and buying here. So 31, a bit of a climactic bar, big tail on the bottom, probably buyers, stepping in relatively soon. Nothing to buy yet, though. If anything, you're short or flat. 32, a bull bar closing near its high. Bears will exit above 32 because of the channel line that we're clearly obeying from 1, 10, 17, and now 31. So we're clearly obeying that channel line. I think traders will look to exit above 32 for a couple of legs sideways to up. Do you buy above 32? I personally wouldn't. I would rather wait for something like 34 or even 35, but I think 34 makes a lot more sense than 32. Some traders might buy 32. It's a bad signal bar, but they're betting on a trading range, and they don't really care if it's a bad signal bar. Since they think we're low in the trading range, that's where basically the overwhelming odds are that we're going to end up getting some sort of bounce. 33 consecutive bull bars, but tails on the top. Again, I would probably just wait for a bull bar closing near its high to buy at this point. You're not in a huge rush to get in the market, and if it just goes up like this the whole time, if we get 5 more bars that look like 33, are you really going to think to yourself, I really wish I had bought above 32? Probably not. You're going to look at it and say, okay, well, whatever. That's, leg in the trading range. That's not a strong trend. I don't really need to be trading it. 34, a third straight bull bar. So usually 3 straight bull bars against you if you're you're in a bear trend, what you think is a bear trend, and you get 3 bull bars against you. It's a pretty good sign to get out. So bears are definitely, if they didn't exit here, they probably are going to exit above 34, and bulls can start to buy. After 3 straight bull bars, we're going to get a second leg sideways to up. And you're buying still relatively low in the range if you believe it's a trading range, which is a very reasonable assumption at this point. You're buying pretty low in the trading range. And you can see we ended up oscillating around the midpoint towards the end of the day, just like we did yesterday, which is pretty common on trading range days. 35, another bull bar, but a tail on top. It's not a big tail, but it's still a tail. But however, it does close above the moving average, which is relatively important. We're basically going to try and get back to the bar 27 low, the breakout point, and then probably start to go relatively sideways. I think there's still more to the upside, but I'm not sure how much more. We're going to enter back into the middle of the trading range, and that's been an area where we've been going sideways most of the day. So I'm not really sure how great it is. I think the best buy in this rally was probably 35 for me personally, or sorry, 34 for me personally. So 34, 35 consecutive bull bars closing near their highs, 35 closing above the moving average, 36 another bull bar, but a doji bar. We're probably still going a little bit higher. We're going to get a second leg sideways up if we do start to go down. However, 5 straight bull closes, if we do go down, we're probably not going that far down. And there's probably buyers below pretty much any bar right now. 37, another bull bar, but a tail on the top and a tail on the bottom. Again, still bull channel though, bull micro channel from 32 to bar 37 at this point. There's no reason to sell anything. So for me, I would just sit long. If you're long, where's your stop? Probably a couple of points below any bull bar. It's true there are probably buyers below pretty much any bull bar right now. However, you probably don't uh, want to be getting caught waiting for the market to go sideways to down before reversing back up. It's probably better just to look to get out if we trade too far below any bar. So I would say, I don't know, 2 points below any bar, maybe 3 points. So I think it just did 36. So 37, another bull bar, tails. 38, another doji bar. So I think, when you talk about spike and channel, I think 32 through 35 is the spike. And we might get some sort of measured move up based on the height of it into this area. You can see we got here, but it was a little bit later. It didn't end up channeling directly up to it. So 38, another doji bar, but we have so many straight bull bars, 32 through 38. There's no reason to basically do anything here. 39, another bull bar, but tails on the top. 40, another bull bar. We now have bull bars from bar 32 to bar 40. So a tight micro channel. There's going to be buyers below the first reversal down. You can see there were buyers below during 41. There were buyers below 40 buying for at least a scalp up. 41 is a high one for the bulls, but probably not really worth buying. I think we're in the middle of the trading range now. So this is more of an area where the bulls who have been long are going to start taking profits. 42, a big tail on the top and a tail on the bottom, but more or less a giant doji bar. It's really not worth doing anything. I'm not really interested in taking any of these trades. And then 43, a strong bull bar closing near its high. Yeah, it's a breakout for the bulls. It's a breakout. This is the best looking bull bar since basically the spike, and we just got a spike and now a channel. Now we're trying to get another spike. However, did it close above the 21 high or at it? Okay, it closed 2 ticks above it. However, you need follow through here, and I don't really know if I want to buy after this many consecutive bull bars. I need to wait for the market to go sideways first. So it's also not a micro channel anymore. So had bar 40, had 41 not traded below 40, this would be a little bit better for the bulls. However, it did, so I'm not going to take it. And you can see most traders, went in with that mentality. It is a breakout above the 21 high, but the bulls need consecutive bull bars if we're going to get a rally here. So disappointment 42, 43, and then an inside bar, bear bar closing near its low on 44. Do you exit longs below 44? I think you can. I don't really see a lot of reasons why you want to. You can just stay long. Sure, is it always in long? Yeah, and we might go higher, but I don't really think that it's necessary to stay long here. I'd probably just get out of my trade and be flat for a little bit. 45 consecutive bear bars, but it's a bear doji bar. It's really not worth doing anything. I'd rather just be flat here. This looks like we're going to enter a tight trading range around the midpoint of the day. Honestly, usually if we're starting to go sideways around bar 45, there's at least one swing trade left in the day, but I'm not all that confident today. We had a couple of swing trades early in the day, and now we're in the middle of the trading range going sideways, and the bars are getting smaller. So I'm not really all that confident that we're going to get another swing trade today. So you probably have to be very careful if you're trying to swing trade. 46, so 3 straight pair of bars, 44, 45, 46. Disappointing for the bulls. A lot of bulls will start to look to exit. 47, another doji bar. So we have a 3-bar tight trading range, 45, 46, 47. And then another inside bar, 48. So an IOI pattern, 4-bar, 5-bar tight trading range. Really just not worth doing anything. I think we're just going to go sideways here. I would just rather sit flat. What do I need to trade again? Well, if I'm going to buy, I would like a bit of a deeper pullback and then maybe a reversal up from a high 2 or a good looking wedge, something like that. If I'm going to sell, I don't mind if we go a little bit higher and get a reversal down from a failed second leg up. Maybe some sort of failed breakout above the 43 high, but I still want to see us go a little bit sideways first. So 49, disappointment, a big tail on the top. Big tail on the top. You can see sellers above 48 after 5 straight bear bars, but really not worth doing anything. Buyers below 49 during 50. Double bottom with 45 or 46, whatever, but really just tight trading range. Probably more buyers below than sellers, but probably more sellers above than buyers. You can see trader spot below during bar 51, and then we get a reversal up 52. But it's a breakout attempt of a tight trading range. And look at 52. If you is 52 impressive to you really in any way? It's really not all that impressive. You can see there's a big tail on the top of it, and it's not able to close above the bar 43 high, so it's really not worth buying. 53 consecutive bull bars, but this is humongous or very much so shrinking bodies. Not worth buying anything here. I would just rather be flat. You can see an outside down bar 54. So bears are hoping we get some sort of higher high double top here, and they want a strong reversal down. But this is just a tight trading range, really, is what you need to realize, and that nothing is all that good in here. So I would start to get really, really, really picky about my trades when we start doing this at this time in the day, around the middle of the trading range on a day where we had a really large range early in the day. Again, once the range gets this big early in the day, it increases the chances of trading range. Days that have smaller ranges early in the day increase the chance of a trend day. And if the range is large and most of the daily range in the first, 15 to 20 bars, that increases the odds that we're going to start to go more sideways. Outside up 54. So it's an outside pattern. Excuse me. Tired today. I'm not really sure why. Outside pattern 54, 55. We might go a little bit higher, but again, a huge tail on the top of 55. So again, to me, this is a tight trading range. But buyers below during 56, a pullback. The bulls hope to the moving average and a reversal up. Bears are hoping this is some sort of higher high double top or maybe some sort of wedge with 55, maybe like that. But again, you don't really want to sell that. And you don't really want to buy down here either. So stuck on the sidelines is probably the best. Inside bar 57, so a high one bar for the bulls, and another inside bar 58. Not quite an inside bar 59, but we had an II pattern 57, 58, which is a breakout mode pattern. Generally relatively 50-50. We have been holding above the moving average, so maybe slightly more bullish, but not really all that great. Once you get a breakout, there's a 50% chance that the first breakout's going to fail. So 59, a bull bar triggering the II, and then we get 60. This is the breakout bar on 60, and it's closing above the bar 55 high, which is good for the bulls. However, you're getting a breakout above the bull channel, which is not really all that high of probability. And you have a really, really important magnet, the bar 15 close, not that far above. And any bull who bought the close of 15 is obviously not thrilled with how their trade went, even if they scaled in and are now at a profit. So you have to be thinking those traders are going to be pretty eager to get out of their trades. So this is an area where if you're buying, you need to be really cautious. This is one of those bars on 61 that I think, well, first off, 60 is not a very good trade. I would not buy 60. I would wait to see if 61 is follow through. But if you do buy 60 and you get 61, it's one of those bars that a lot of people look at and say, well, maybe it'll go higher. And it's really just better to get out on the close of 61. This is an area where you know that these bulls are eager to get out. So if you're buying up here, you need to be really, really picky with your follow through. It needs to be perfect. You need to, kind of look at it when you take the trade and visualize what your follow through needs to be. And it probably needs to look exactly like bar 60 and be closing above the bar 15 close. If we get another bar that looks like 60 and it closes somewhere up here, well, then great, you're in business. You can buy above that. But if you're not getting that, a lot of traders will just be eager to dump out of their longs on the close of 61. And that's part of what's causing 62. The other part of what's causing 62 is the bulls who bought up here and scaled in are happy to take a small loss on the first entry and a profit on their second entry and just exit the trade because obviously it did not go well. So that's part of what's causing bar 62 as well. Bar 62 is a big enough bear surprise that we're going to get at least a second leg sideways to down. However, it doesn't mean we're going to go a whole bunch more down. To me, this is big up, big down, and big confusion late in the day. 63, an inside bar, a low one short, but I'm not selling this. I would pretty much be done for the day. For me personally, once we started to go sideways, I sat around a little bit until like bar 55, but I just ended up walking away and being done for the day around then. 66, or sorry, 64, probably sellers not too far above. You have to expect a lower high from 62 and 63 because it's a surprise and a second leg down. So you could argue we had a spike, bar 63, and then we had a wedge channel, bar 64, 68, and 71, and reversal up, but not that no one wants to buy above bar 71. So it's really not as good as it could be. So, most of the trading today was done in the first 20 bars, which happens sometimes. But for stop entries, I thought 10 was credible, but you have to realize it's probably going to go more sideways first. Big bar, because we're in the middle of a trading range, big bar, big risk. So we might, again, go more sideways, and traders might sell a 50% pullback or buy a 50% pullback. 16, a giant bear bar closing near its low. It's a big surprise for the bears. Why are bears going to be eager to sell below it instead of 50% pullback? Because the bulls are trapped. Any bull who was long for any reason is going to be panicking out on below bar 16. And it's pretty obvious that there were a lot of bulls who were long from a little bit earlier. Obviously, it's set up on 10 and then 14, 15, etc. So bulls are trapped. It's reasonable to bet that they're going to exit their longs. And that's part of what's causing bar 17 for the bears to be able to make 20 points. Also, if you're buying, 10's a surprise, but 9's kind of an equally big surprise. This is the best looking bar of the day. And if you're buying above 10, you're buying the upper third of the trading range so far, versus if you're selling below 15, you're selling near the midpoint. Not great, but I think the context is overwhelmingly good for the bears. And it's early enough in the day you can take a chance. If you buy above 19, I would not. I'd rather wait. 28 makes sense. You exit above 32, or you scalp a piece and then exit the rest above 32. And then buy the close 34, 35. Probably all buy the close bars up until maybe 41, 42. Or I'd be done buying the closes 42, 43 for sure. Then you can exit below 44, but it remained always in long. And 60, a breakout attempt above the channel, but there's resistance above and we're high in a trading range. So I'd rather wait. And then we get a wedge reversal down. Like I said, spike, pullback, wedge channel, but not very good. The daily chart, I guess the obvious limit order traded on the day would be buy below 40 for a scalp. The daily chart, it's a bull bar, but it's really not all that good. We have, again, yet to trade below any prior day's low for a lot of bars now. Basically 13 bars. Yeah. So it's been a long time since we traded below prior day's low. What that means is the first time we do trade below the prior day's low, there's going to be buyers. So if we do end up going below this 821 low tomorrow, there's probably going to be buyers and look for a reversal up. It's the same concept as buying below bar 40 today. There's so many straight bull bars and such a strong micro channel. There's going to be buyers below here. So if tomorrow, let's say we gap down into here and then we trade down to, this area, or we go below the low and then we get a reversal up with a good looking bull bar, that's going to be a really credible buy. So do I think we're going here? Yeah, we're definitely going here. But the question is it going to be part of the first leg, or leg one pullback and then leg two to a new high? I think the one pullback two is maybe a little bit more likely. But again, we could just vacuum up to the high, but I'm just not that convinced we're going to directly go to the high. I still think we might try and pull back towards the moving average first. The weekly chart, really important to see if the bulls can get a strong bull bar here. If they can get a strong, you can see they're testing back to around this close. And the bulls who bought that close, obviously 56.68, are not going to be that happy with how this trade went. But again, this is strong enough. We're going to get another leg sideways stop regardless. So while we might pull back, we're obviously going to get to the new high. The question just becomes, are we forming a trading range here? And I think the answer is yes, but we might have to go a bit higher first. But I would not be surprised if we form a trading range, a really wide trading range between 5,000 and 6,000. There's something Al said in one of his old recordings. We talked about the market is going to have to go sideways for 5 to 10, or maybe 10 years. He said like 7 to 10 years, something like that. And he said, this was a recording from like 4 years ago I watched. He said that he expects that within 10 years, the market's going to go sideways for 10 years. It was something along those lines. And, maybe if we have a really large trading range between something like 5,000 and 6,000, or, maybe if we go a little bit lower, that'd be, 4,800, whatever, and 6,000. But a giant trading range of 1,000 plus points would make sense for something to go sideways for that many years. But we would probably need to be even larger. But anyways, all right, that's the day.